Hello, and welcome to our continued discussion of PepsiCo's 2014 annual report. In this video, we will look at its shareholders' equity section, its payout ratio, and its return on common shareholders' equity ratio, known as ROCE. So we have to look deeper within PepsiCo's annual report for more information about shareholders' equity. We'll look at the income statement on page 67, the balance sheet on page 71, the statement of equity on page 72, and we'll look at footnote 12. So looking at the statement of income, we've already seen that we want to look at how much net income is attributable to the shareholders of PepsiCo after any income that's been added in or consolidated that belongs to non-controlling interest. In 2014, we said this is $6.5 billion. Interestingly enough, we haven't focused as much on earnings per share, which is net income minus preferred stock dividends over weighted average common shares outstanding. If I owned one share of PepsiCo in 2014, that share would have earned $4.31 on average. The basic number is before taking into account other people that have the option to buy shares a little bit cheaper than I do and thus dilute the value of my share. Note that on the income statement, in addition to earnings per share, we are given cash dividends declared per common share. So if there's earnings per share of 4.31, little more than half of that is declared as dividends. We'll come back to some of this information when we look at the payout ratio. So we care about how much net income is attributable to the shareholders of PepsiCo, not companies they've consolidated but don't own 100% of. And we can look at things either on a per share basis, but in the ratios we're looking at today, we're going to be looking at on a dollar basis. So $6.5 billion worth of net income for PepsiCo shareholders in 2014 versus $6.7 billion in 2013. On the balance sheet, we'll focus on the equity section. So notice that PepsiCo does have preferred shares. It's sort of a weird transaction related to an employee stock ownership plan of a subsidiary that they bought in Campbell's. It's a little beyond the scope of this course, but there is a few shares of preferred stock, not nearly as many shares as common stock. And we'll see that PepsiCo, like a lot of companies, has a stock with a par value, an arbitrary legal value that is very small, 1 2/3 cents per share. They have the ability to issue up to 3,600 million shares or 3.6 billion shares, but remember, shares authorized is only potential. The shares that they actually issued are the shares outstanding, 1.488 billion, if you add back the number of shares that they repurchased. Note that when they talk about two numbers for common stock and shares, here they call it shares issued net of those repurchased. The number on the left pertains to the column on the left, which is 2014. The number in parentheses on the right pertains to the column on the right, which is 2013. Altogether, PepsiCo has common stock at par value. Of course, when they sold these shares, they sold them a lot in excess of par value. People pay a heck of a lot more than 1 2/3 cents per share. In fact, the current share price is a little over 100. And we have retained earnings, this funny thing called accumulated other comprehensive loss, which is a little beyond the scope of this course. And finally, repurchase common stock, which is another word for what your book calls treasury shares. Altogether, adding these things up, which is our contributed capital, our earned capital, less the shares bought back, PepsiCo common shareholders' equity is about $17.6 billion. We said that this negative number, treasury shares 378 million in 2014, and it cost us 24.9, almost 25 billion to buy them back. If we want to find out the cash dividends declared on common shares, preferred shares, even these things called restricted stock units or profit sharing units, we look at the statement of equity in the account retained earnings. Notice there's a balance at the end of the year for retained earnings in 2014, 49 billion, which is the same as it was in the balance sheet on the previous page. So we'll need cash declared. The board usually meets, declares the dividend. It may or may not be paid in the same year depending on the date of declaration and date of payment. And I excerpted some information from footnote 12, which talks about that preferred stock, very small but very weird looking for PepsiCo. So they had 3 million shares of it authorized related to an employee stock ownership plan for one of its subsidiaries, Quaker, and the people that participate in the employee stock ownership plan can redeem it for common stock. They tell you that the preferred stock gets dividends at a rate of $5.46 per share. There were 803,000 shares issued, but a lot of them have been repurchased, so there's very little outstanding. If we want to analyze equity with ratios, we're looking at these profitability ratios, which measure a company's income or operating success over a period of time. The payout ratio basically is how much of this net income that you've earned available to common shares do you give back in form of cash dividends. If we look for PepsiCo on the statement of equity, cash dividends declared on common shares, 3.8 billion, as a percentage of the net income available to common shareholders of 6.5 billion is 59%. PepsiCo paid 59 cents as a cash dividend to common shareholders for every dollar of earnings. In 2013, the payout ratio was lower. If they only paid out 51% of net income, then they reinvested more of it in PepsiCo. A mature company like PepsiCo with steady earnings often has a relatively high dividend payout because they're profitable. Hopefully they're generating cash flow and they have access to borrowing if they need extra capital resources. So it's not unusual for PepsiCo to have a relatively high dividend payout ratio. One of the most important profitability ratios is return on common equity. This says for every dollar of common shareholders' equity invested during the year, what percentage did you earn in net income after deducting any dividends that you paid to other types of stock? So PepsiCo net income for common shares was 6.5 billion, very little amount of preferred dividends in the statement of shareholders' equity. And we have common equity this year as well as last year. PepsiCo's return on common equity, meaning it earned 31% or 31 cents on every average dollar of common equity invested in 2014 versus 29 cents in 2013. According to this ratio, PepsiCo was slightly more profitable in 2014 for every dollar invested. The reason why return on common equity went up, even though net income went down, is that PepsiCo's common equity went down. This is a measure of efficiency. Net income generated for average common shareholders' equity invested. The reason why it is because you see equity went down because PepsiCo bought back shares of common stock. So PepsiCo not only paid dividends to shareholders, it repurchased some shareholders' shares. Please feel free to use this presentation as a review before looking at the shareholders' equity for your company and calculating its payout ratio and ROCE. The discussion will help you compare your company to another in a different industry. Good luck and get started, Jaspers.